Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of bond yields and interest rates. What investors need to know in 2024. Historical trends of bond yields and interest rates. The dance between bond yields and interest rates has been a defining aspect of economic cycles throughout history. In high inflation periods, like the 1970s, the Federal Reserve raised interest rates dramatically to curb inflation, leading to soaring bond yields. Fast forward to the early 2000s, another interesting trend emerged. Following the dot-com bubble burst and September 11 attacks, the Fed reduced rates to stimulate growth, causing bond yields to plummet and bond prices to rise. The 2008 financial crisis marked another pivotal moment. Central banks lowered interest rates to unprecedented levels, flooding the market with liquidity to support economic recovery. This environment of low rates drove down yields and fueled demand for bonds as investors sought safer havens. Today, post-pandemic policies show central banks gradually hiking rates to combat inflation, impacting yield trends once more. Bond investors need to keep tabs on these shifts to anticipate bond market movements and adjust their strategies accordingly. History doesn't just record numbers and events. It offers insights into how bond markets respond to economic pressures and policy decisions. Understanding these historical patterns empowers investors to make informed choices in a shifting economic landscape. Investment strategies considering bond yields and interest rates. Navigating the world of bond investing requires careful strategy, especially when interest rates are on the move. Understanding how these elements play together is essential for crafting a portfolio that's both resilient and profitable. Bond investing in a rising rate environment. When interest rates are creeping up, bonds can seem less appealing. But with the right strategies, you can still make them work for you. Here are some ways to approach bond investing in a rising rate setting. Shorten bond duration. Opt for bonds with shorter maturities. They're less sensitive to interest rate changes, making them a safer bet. Picture them as tightrope walkers who don't sway much with the wind. They keep their balance even when rates shift. Consider floating rate bonds. These are like chameleons, they adjust their returns based on prevailing rates. When rates rise, so do the payouts, offering potential protection against rate hikes. Stagger maturities. Use a bond ladder strategy, where you stagger bond maturities over time. It's like planting crops that mature at different seasons, ensuring you're always harvesting returns, no matter the rate climate. Focus on quality. Higher-rated bonds tend to weather rate hikes better. While they might offer lower yields, their stability can be invaluable in rocky times. Exploring these strategies helps create a buffer against the potential downsides of rate increases. You're essentially building a financial fortress with each bond placement. Diversification and risk management. Just like not putting all your eggs in one basket, diversifying your bond holdings is crucial. It's about spreading risk and ensuring you're not overexposed to any one factor or market movement. Mix bond types. Include a variety of bonds, like government, municipal, and corporate bonds. Each responds differently to economic changes, providing a cushion against market volatility. Vary maturity dates. Blend short-term, mid-term, and long-term bonds. This mix can help manage risk and optimize returns, regardless of whether yields are going up or down. Global exposure. Consider international bonds. While they bring currency risk, they also offer exposure to different economic cycles and interest rate environments. Think of it as tapping into growth stories beyond your backyard. Hedge with interest rate derivatives. Use swaps or options to hedge against interest rate movements. These instruments can act as insurance, guarding your portfolio against unexpected rate swings. Diversification isn't just a checklist item, it's an essential strategy. It's your portfolio's safety net, enabling you to adapt to changing yields and interest rates while minimizing risk. Future outlook for bond yields and interest rates. The future of bond yields and interest rates remains a hot topic, especially as we step into an uncertain economic landscape. What should investors expect in the coming months? Let's break down some plausible scenarios and factors to keep an eye on. Influence of economic indicators. Several pivotal indicators may shape bond yields and interest rates in the near future. Will they go up, stay steady, or take a dive? Inflation trends. Inflation is a big player here. If inflation rates keep climbing, expect central banks to raise interest rates in an attempt to cool things down. Higher rates could lead to rising bond yields as investors look for better returns to compensate for inflation risks. Job market dynamics. Employment figures could set the pace for future rate decisions. Robust job growth might prompt rates to rise, reflecting a healthy economy. Conversely, sluggish job data could put a brake on rate hikes, keeping yields in check. Economic growth. The broader growth outlook matters, too. Strong GDP numbers signal confidence, potentially pushing rates and yields upwards. Weak growth, however, may lead to more cautious rate adjustments. Central bank policies. The decisions and strategies of central banks are crucial. What might these institutions do next? Rate hikes and cuts. Central banks might increase rates if they see inflation creeping too high. On the flip side, rate cuts could happen if economic growth stalls or recession fears loom. These moves directly affect bond yields, as they adjust to remain attractive. Quantitative easing. This tool could come into play again if economic conditions worsen. An increase in bond purchases by central banks pumps money into the economy, likely keeping yields low. Global coordination. Sometimes central banks coordinate efforts, especially during global crises. This collaboration could stabilize or shift rates depending on the shared economic objectives. Global political and economic developments. Politics and global trends also have their say. How might these elements tilt the scales? Geopolitical tensions. Political unrest or conflicts could make investors wary, driving a flight to safety. This fear factor might lower yields as demand for safe haven assets like bonds increases. Trade dynamics. Ongoing trade negotiations or disputes influence economic policies. A favorable trade environment might boost growth prospects, potentially raising rates, while trade tensions can have the opposite effect. Technological advancements. Innovations can spur economic change. As new industries rise and transform economies, rate policies will adapt to these shifts, impacting yields in uncharted ways. Keeping an eye on these influencers helps investors adapt and strategize effectively. The bond market's future isn't set in stone, but being prepared for potential changes is what makes you a smart investor. Stay informed and ready to pivot as the economic landscape evolves. Conclusion. Investors must recognize the interplay between bond yields and interest rates to make savvy decisions in 2024. Understanding their dynamic can illuminate market trends and risks, shaping your strategy effectively. As you grasp this core relationship, you'll find yourself better equipped to navigate the shifting tides of the financial markets. Take a moment to think about how these elements fit into your investment portfolio. Are you positioned to capitalize on rising rates, or do you need to adjust your approach? This knowledge gives you the tools to manage risks and seize opportunities. Share your thoughts or questions in the comments. Let's keep the discussion going. Stay informed and adaptable, and you'll maintain a sharp edge in an ever-changing market landscape. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.